Hey, it's Mike Camber at FlipNerd.com. Welcome back for another exciting expert interview, where I interview successful real estate investing experts and entrepreneurs in our industry to help you learn and grow. If you haven't checked out the all-new FlipNerd.com, go check it out, FlipNerd.com. It's growing rapidly. We have hundreds of properties, hundreds of vendors, and it's turning into a great one-stop destination for real estate investors. For today's show, I'm joined by Edwin Kelly. He's the CEO of Specialized IRA Services, and he's helping Americans take control of their IRA to attain financial freedom. Edwin's a leading expert on self-directed retirement accounts. And while we've talked about those in the past, today's going to be a little bit unique. We're going to talk about alternative self-directed accounts like solo 401ks and health savings accounts. And there's a lot more to them than you know, unless probably a lot more than you think you know. So before we take a deep dive into this and get started with Edwin, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days with rates starting as low as 9%. For more information, call 888-296-1697. B2R Finance makes loans tailored specifically for rental investors. They can help you unlock equity from existing properties so you can get cash to grow your rental portfolio. That's huge, and it opens up lots of opportunities previously not available to rental investors. Need a loan? Call 855-819-4412 or visit b2rfinance.com today. National Real Estate Insurance Group is the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. We'd also like to thank Crestar Funding, Mid-Atlantic IRA, and Renters Warehouse. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Edwin, welcome to the show.
Hey, Mike, it's great to be here.
Yeah, good to see you again. For those that don't know, Edwin just joined a mastermind group that I'm in, so we actually had dinner together just a few weeks ago, so had some interesting conversations there. It's interesting as a real estate investor I've bought hundreds of houses, and we've really never utilized self-directed accounts up until this point, but every kind of month that goes by, every time I talk to somebody in the self-directed space or had a chance to talk with you, I just keep kicking myself as to what are we doing? Why haven't we done this earlier? And so this will be one more kick in the butt for me to get out there and do something. So I'm glad you're here today.
Yeah, well, I'm so glad to be here. I appreciate it.
Yeah. Well, Edwin, before we kind of get started talking about this stuff, why don't you share to us how you got into this? Because I know you have a long background in real estate investing. Kind of tell us how you got started and how you got to where you are today.
Yeah, so it's interesting, Mike, because I was always interested in money from the time I was young, and I remember in 6th grade, I knew at that point in time I was going to be financially successful in life. Didn't know how I was going to do it, but I knew I wanted to do it. So I started doing odd jobs in junior high, middle school, saving money, and I decided that I wanted to start investing, believe it or not, in junior high. So, of course, being a minor, there's rules around that, right? So I opened up what's called an UGMA account. And an UGMA account is an account, it's a brokerage account that, you have a responsible individual or a legal guardian, basically, who's over the age of 18, sign up, but it's for your benefit or for the child's benefit. So I opened up this account and I put money in it. I put my savings in it. And the very first investment I ever made was I bought a stock in a company called Chuck E. Cheese.
Oh, yeah.
So for everybody who has kids, they know Chuck E. Cheese, right?
Yeah.
And I remember I bought that stock.
And they want to forget it. By the way.
Exactly. I have kids of my own now. Thank goodness we're past those years. But but the great thing was I bought this stock, Chuck E. Cheese, and I bought it at $18 a share. Now, my grandfather was the responsible individual on that account at the time. And so the stock went from $18 a share to $42 a share. And so I was so excited, right? I mean, it's like, hey, I doubled my money. It took about 12 months for that to happen. And I said, okay, now I'm going to sell it. And my grandfather said, nope, you can't sell it. And I'm like, well, why not? He says, well, you own stocks for the long run. And I said, well, I get that, but I'm not going to go spend the money, but I want to get out of this stock and I want to look at buying something else because it's more than double. He says, no, he wouldn't let me sell it. He says, you need to stick with it. And what happened was Chuck E. Cheese ended up filing for bankruptcy. Now, what a lot of people are not aware of in the investing world is that when a company files for bankruptcy, because Chuck E. Cheese is still around, you know the company.
Sure.
This goes back many years. I'm not going to date myself, by the way, how many years ago this is. But when a company files bankruptcy, the court can allow them, and in this particular case, they did, allow them to wipe out all existing shareholders. So my $42 investment went to zero. Right. I lost 100% of my investment. Now they're still around. They reemerged. They were able to issue new stock.
Reorganized.
But I lost all my money.
Right.
Which I didn't like that very much.
Yeah.
And so I kept on investing though. I kept sticking with it. And by the time I got into my early 20s, I said, there's got to be a better way to do this. Because the market goes up, the market goes down. You think you make money, and then it takes it away the next year. And I saw this roller coaster ride happen over, since I had been investing since I was in junior high. I mean, I saw this happen, by the time I was in my early 20s and in college, I'd already seen this play out a couple of cycles.
Right.
Right. And so I knew there had to be another way to do this. And so I started looking at alternative ways of investing. And I hate to even call them alternative, but they're alternative to what most people are doing. That's why I use them. Right. And so one of the things I came across was real estate. In fact, the thing that I found out was that the two ways that most people create wealth in this country is through one of two avenues. They own real estate and they invest in real estate, or they own businesses. That's how the top 1% become the top 1%. Mm-hmm. And so at that point, I said, okay, I need to shift my investing strategy. And I had three things that I wanted to achieve. I wanted to achieve predictability, a high level of certainty in my money coming back, right? Because ROI, there's two types of ROI. Not just return on investment, but return of investment. That was the lesson I learned back on Chuck E. Cheese. And so the third thing is security. Real estate is an example. I think one of the reasons why you have so many followers and people are implementing what you're teaching and coaching and sharing with them is because you can achieve all three of those things in real estate: certainty, predictability, and security. And so the investment part was one part of it, but the other part of it is the tax side of it.
Right.
Because the problem once you start making money is you find out very quickly, well, who gets paid first? I mean, we own our businesses, so in a sense we could say we get paid first, but that's not really the case, right? The government takes their fair share first, and then we get what's left over.
There's a difference between what you make and what you keep, right?
Right. There's a huge difference in that. And so what I learned along the way was, we have a choice. A lot of people don't realize this, but we have a choice. We can pay ourselves or we can pay the government. Well, I would rather pay myself because even if I do something dumb with the money, I have only myself to blame, right? I already know the government's going to do something dumb with my money. I don't need to give it to them. So I started paying a lot of attention to taxes. And one of the best ways to reduce, defer, or eliminate taxes is the use of IRAs and retirement accounts and other tax advantage savings accounts, as we call them. And so I started looking at these tax protection vehicles as a means of sheltering the taxes and looking at real estate and these other investment strategies as a way of growing and compounding that money and that wealth tax-free. And when you bring them both together, that's really where you hit the sweet spot, and that's where long-term true wealth is created. And it's not just long-term, because when we talk about retirement accounts, I know a lot of people think, oh, this is something that's only going to benefit me in the future. That's not true. You will put more money in your pocket today when you know how to use these accounts, and you will also put more money in your pocket in the future. But it's today and tomorrow, and there's ways to do both.
Yeah, so, and I think that's probably a common misconception is people think, well, that sounds awesome, but I don't want to wait till I'm 70 years old to enjoy the fruits of my labor today when I'm in my 30s or 40s or whatever age people might be at. So maybe just share. I know we're going to talk about solo 401ks and health savings accounts. Maybe you could just right up front here give an example or two about how using those vehicles could benefit someone today where they don't actually have to wait till they're retired. Okay,
so let me start by defining what an IRA is and what a self-directed IRA is, and then we'll talk about that.
Sure. Okay.
Play us into that 401k. So What is an IRA? An IRA is an IRS-approved vehicle that allows us to make investments, put money in that account, and grow our money tax-deferred or tax-free, depending upon the type of an account we have. Okay? Now, to take it one step further, what is a self-directed IRA? A self-directed IRA is an IRS-approved vehicle that allows us to get all those tax benefits. But the big difference between a self-directed IRA and what I call a plain vanilla IRA, which is what you get at the bank or the brokerage house, is that a self-directed IRA allows you to have complete control over your money and invest in anything that you choose to invest in. So one of the big misconceptions that people have is that they say, well, in fact, I hear this all the time. I have a self-directed IRA, it's a Scottrade. Okay, well, that's not what we mean by self-directed. What Scottrade means when they say you have a self-directed IRA is that you can buy any commissionable, if I can say that right, commissionable. We don't charge commissions, so that's why I can't say that right. But you can buy any commissionable investment that we offer. Mutual funds, CDs, stocks, bonds.
Right.
You can pick anything that we quote approve, right? And that's what they mean by self-directed. That's not what we mean. When we say self-directed, we mean that you can invest in anything that the IRS allows, right? So or the government allows. And so there's a whole realm of options there. And what I tell people is that you're virtually limited only by your own creativity. So the self-directed IRA gives you complete control over your retirement account and allows you to take full advantage of all these tax protections and other benefits. So that's kind of the baseline. Now, the question you asked me about was the solo 401k. The solo 401k, it's referred to as different things if you do some research. An individual K, an individual 401k. There's various names that it goes under, but it's all effectively the same thing. There's a lot of advantages to the solo K over the IRA, and we're going to touch on some of those today. Actually, we probably won't have time to touch on all of them, but we'll touch on some of those benefits. But your specific question was, well, how does that account benefit you today? So let me give you two quick examples, and we can go from there.
Sure.
One advantage is that the 401k allows you to put more money in it today. So with and I won't get into the specific contribution limits, they change from time to time. So the best way to find out is you can just contact the office. We can tell you what the current contribution limits are. But just to give you a feel, you could put $50,000 to $60,000 a year into that solo K from a contribution standpoint, right? And by the way, when we say solo K, that's for you, Mike, or you and your wife, as an example. You guys are married and you work in the business together. So one of the things that people will say is, well, how do I get around the small contribution limits on IRAs? Well, here's a way. You can put more money in this year. Between you and your wife, you could put, what is that, $100,000 to $120,000 in to that 401k this year if you wanted to, right? Wow. Here's the other nice benefit, is that you have complete control over the tax treatment on that money. Meaning if you told me, Edwin, I want to lower my taxes this year, okay? We can set it up to where you get $120,000 tax deduction this year, okay? If you said, I want that money to be like Roth money, tax-free, so I never have to pay taxes again, but I know that, I've been told I make too much money, I can't make Roth contributions. Guess what? That $120,000 can be all tax-free money if you want it. If you said, Edwin, I want both. I want to deduct some of this, but I want some tax-free. Guess what? You can do that too. So one of the benefits today is that you can put more money in, and regardless of your income limit or level, you can make those contributions tax deductible or tax free. So that's one quick benefit you get this year when you set one of those plans up.
Sure.
Here's a second benefit. One of the challenges that I'll hear from some investors is that they say, well, the reason why I don't have a retirement account is because I feel like, or I don't put a lot of money in the retirement account, is because I feel like when I put money in, I lose control over it. Well, I'll say two things about that. First is that's true when you have it at a plain vanilla IRA at a bank or a brokerage. You don't have any control over it. They control it, right? So that's a true statement. But when you have a self-directed retirement account, you can do virtually anything in that account that you can do outside that account. So, Mike, anything you're doing right now outside of your account, you can do inside that IRA as well.
Right.
But here's the second answer, and this is another reason why that solo K is superior to the IRA. if you're not familiar with how some of the rules and regulations on how these accounts work, one of the things you need to know about IRAs is that you cannot use that money personally, right? You can't do that. But the 401k is the only account that allows you to take out a personal loan from it. That loan is tax-free and penalty-free. So if you're 40 years old, as an example, and you have $100,000 right now in, say, a traditional IRA, we could transfer that traditional IRA from your bank or brokerage into a self-directed 401k. Then you could immediately turn around and borrow $50,000, tax-free, penalty-free. If you're using it in your business, if you're restructuring debts, whatever you want to use that money for, you can use it for any purpose you choose. You can pay that money back. You pay it back with interest, but who did you borrow the money from? You borrowed it from your own account. So you're basically taking money out of one of your pockets, you're putting it in the other pocket. And so really it's what I refer to as a zero cost of capital. Yep. So with the Solo K, you have access to your money today through tax-free, penalty-free loans, as well as having complete control over that money when it's in a self-directed Solo K, and able to invest in anything you'd want to invest in anyway.
Yeah, and there's some stipulations too, like you have to have that paid back within a certain period of time, right? I mean, you take out a loan from yourself, and it has to be paid back within how long?
Yeah, so the way the loan provisions work is that it depends on what you're using the money for. If you're taking it out for any purpose, it's a fully amortized loan over 5 years. Okay, so 5 years is the payback term. This is all defined in the code, by the way. So a lot of these things are things that the government says, okay, we'll let you do this, but here's the rules you got to go by. So so one of the rules is you're gonna pay it back over 5 years. Now there's an exception to that rule. If you're taking the loan out to pay or to purchase a primary residence, investment property is not going to work. Okay, so it has to be a primary residence. Then the way it's written is that could reflect the way that you would normally structure a loan of that type to buy a primary residence. 15 years, 20 years, something like that. Most people aren't borrowing money to buy a primary residence. They're using it to make an investment, to do something in their business, to do some education and training, that type of thing. So that's going to be a 5-year payback. Okay. Interest rate is prime plus 2, generally speaking. So you can look at what prime is. You add 2 points to it. Like I said, that's kind of a moot point.
Sure.
It's way lower
than yourself.
And you're paying it to yourself anyway. I mean, it's all your money. It doesn't really matter what it is.
Yeah. Well, maybe at a high level, you could just, I don't want to take up too much time talking about this, but one of the beauties that a lot of folks don't quite understand generally of self-directed IRAs, and again, I'm not an expert, so anything I say that's wrong here, tell me that I'm wrong, because I know I want you to, is that those accounts can actually borrow money and effectively lever themselves.
Yep.
And it has to be, I know it has to be a non-recourse loan typically, things like that. So, but is that the same thing for a solo 401k as a Roth IRA? I mean, a self-directed IRA?
Right. Yeah. So here, and you hit on a huge benefit here.
Yeah.
So one of the things that people are not aware of is that if you don't have all the money in a retirement account, IRS rules allow your retirement account to borrow it. Mm-hmm. So literally, I have a gentleman, just a quick case study here for you, that he's a client of mine in Akron, Ohio. Opened up his very first Roth at 53 years old, right? Put $4,000 because at the time that's all he could put in it. He says, well, what do I do with $4,000? Well, what he quickly learned was he could borrow money from someone else's. It doesn't have to be from the retirement account, but he can borrow money from a bank. He can borrow money from someone else's retirement account or from their own, wherever the money comes from. They lend it to him to purchase a property in his Roth IRA. He says, well, wait a minute. I really don't need hardly any money in my Roth IRA to grow a Roth IRA.
Right.
And so that's what he started doing. He's acquired over 80 properties in about 7 years in that Roth IRA.
Wow.
Here's the thing, and this is the thing that you mentioned. When you're going to borrow money in an IRA, there's 2 things you need to be aware of. First is that you need what's called a non-recourse loan. A non-recourse loan, because there are some rules around it. And if you want to get into what that means, Mike, later we can. But for the sake of time, I'll just point it out. That's what you need. Just be aware of that.
Yep.
Second thing is that the government says, we'll allow you to borrow money in your account if you don't have enough in it. So by the way, this is a legal back door to getting more money in your account past the contribution limits. So that's why this is really powerful. But here's the trade-off. Whatever profit you generate in that retirement account from the use of that debt we're going to charge you something called a UBIT tax, unrelated business income tax. Okay. And so that is taxable. Now, again, without getting into all the issues on that, you can take deductions and everything else if you trigger a tax. But I just want you to understand those two things, because here's the benefit to the 401k. You could do that same transaction that you just did in that Roth IRA, but we could do it in a Roth 401k. You do that transaction in Roth 401k, you eliminate the UBIT tax.
Wow.
So the tax goes away when you're debt financing property inside that retirement account. So again, that's just another benefit. I mean that.
Yeah. So let's go back to that same example. Let's say this gentleman that you referred to has $4,000. Let's just use a hypothetical. It was in a Roth Solo 401k. $4,000 in there, and he's able to get a non-recourse loan to let's just say he wants to rehab a house and resell it.
Yep. So
let's just say he borrows some amount from a lender that's willing to do a non-recourse loan, and let's just keep that math simple. Let's just say it's $60,000 or so. So he borrows $60,000, uses his $4,000, ultimately rehabs it, resells it, and let's just say he makes $20,000 of profit. So that $20,000 would go back into his Roth IRA account. So he started with 4, he levered it up, put 20 back in, plus paid himself the 4 back. And because that's a Roth self-directed IRA, he'll never pay taxes on that additional $20,000, even when he withdraws it when he becomes of age.
Okay, so to clarify,
I'm sure there's some technicalities in here. So,
right. So on the Roth IRA, he would pay tax on some percentage of that profit, because some of that $20,000, to use your number, right, came from the use of debt.
Okay.
Okay. So now he could take deductions, right, because you actually file a return when you trigger UBIT in an account. So you take deductions and everything else. He may or may not pay tax, but you're going to file a return. However, if we did that deal in the Roth 401k, that whole $20,000 is 100% tax protected. No UBIT tax. And the second part of your question was, when he turns the magic age of 59 and a half and he takes a distribution, right, then yes, that comes out 100% tax-free. No income tax, no capital gains tax, no AMT tax, no tax at all.
Wow. That's powerful.
It's super powerful. In fact, the Roth, and by the way, he does have a Roth Solo K today. The reason why we did a Roth IRA was when he opened it, they didn't offer the Roth 401k. Okay, the Roth 401k was introduced. Those rules were amended back in 2006. And so starting in that year, you could actually make Roth contributions. But up until 2006, they only had Roth IRAs. So once they came out with the Roth 401k, we did set up a Roth 401k. So he's got multiple accounts that he's doing this with, but he started with the Roth IRA. That's where he started at.
Okay.
Well, people don't have to start there anymore.
Yeah, wow.
They can start with the Roth 401k.
So let's we could probably have like a 4-part segment on this stuff, but let's talk for a few more minutes about solo 401ks, because then I want to get into HSA accounts, health savings accounts. So maybe you could share some of the kind of unknown benefits. I know we talked about a few of them already, but about a 401k, a self-directed 401k versus what more people know of, which is more of the self-directed IRA.
Okay. Yeah. So let me give you a couple additional benefits to the 401k. Again, this is why I get so excited about it. You can put more money in it, right? You can make that tax-deferred contribution. You can make it a tax-free contribution like a Roth. Income limits don't apply. So regardless if you make $1 million this year, Mike, you have full the permission of the U.S. government to make $1 million this year and still make that $50,000 to $60,000 Roth contribution to your 401k plan. Okay. No income limits come into play.
One question about that. So with let's say that you had the ability to put, let's just use 50,000 into your, if whatever the limit would be, is that based off of a percentage of your company's earnings? I mean, do you have to, in order to put 120,000 away, let's say for a couple, let's say they're a husband and wife owner of a business, put away 60,000 each, $120,000. Does the business have to make more than 120,000, or it has to at least make that amount, or some multiple of that, or how does that work?
Yeah. Good question. So on the 401k, there's 2 buckets. Okay. And the best way to think about this is, well, there's 2 buckets, or there can be 2 buckets. Tax deferred, like a Roth IRA. I'll say that there's 2 hats also that you can wear. Okay. So Mike, you are an employee of your business. right? As an employee, you are eligible to contribute up to 100% of your income, not to exceed. It depends on the year. They've been indexing this, and it depends on your age. But the range, we'll just call it $17,500 to $23,000. Okay, so if you pay yourself $30,000 this year, you could put, actually, let's just say $100,000. We'll make the math simple. So if you pay yourself $100,000 this year, you could, if you're over 50, put $23,000 in there. Okay, up to 100% of your earned income. So that's how that first hat works. So that's your employee hat. You're going to take off your employee hat and put your employer hat on. As the employer of your business, you're going to say, man, I did a great job this year, so I'm going to make a full profit-sharing contribution or performance contribution. You can go up to 25% of your compensation. Okay? So 25 not to exceed $33,000. I want to say it's $33,500, okay, this year. Again, for current contribution, let's just check with us. So 25% times 100,000 is 25,000. So the 25 plus the 23, right? So what are you at? 48? Is that right? About $48,000? Yeah. So you're about $48,000. So there's two percentages and there's $2 amounts. Depends which hat you're wearing. The employee hat or the employer hat. You can go up to 100% or up to 25%. It's tied to your compensation.
Gotcha.
So that's the number they're going to look at.
Okay. So sorry. So we're going to talk about some of the benefits of a solo 401k versus, self-directed 401k versus self-directed IRA. Right.
So here's a couple more benefits.
Yep.
To that 401k. So one benefit is that one of the things that people will say sometimes is, well, you know what? I know that there's rules and regulations, and I know that there's pretty stiff penalties on an IRA, self-directed IRA, if I make a mistake in that account. Okay. One of the things that we're big on at our company is educating clients so that they set their deals up correctly. And so the rules are things that you can learn, and you can invest according to the rules. It's not a problem for most people, but it is something that people sometimes get a little concerned about, usually because their financial advisor tries to scare them and say, don't take your money out of the stock market because you could lose it if you did something wrong in your IRA account.
Right.
The penalties on an IRA, if you do a prohibited transaction in an IRA, as an example, is that the entire account is subject to that penalty. However, with a 401k, the penalties are generally limited only to the transaction itself.
Oh, wow, that's great.
So completely reduce the risk, particularly if you're getting started and you're not familiar with some of the rules and regulations, in terms of if there was a penalty triggered, you're going to limit what that penalty is using a 401k plan. So that's another big benefit. Here's another benefit beyond that. Asset protection, right? We're all concerned about protecting our hard-earned assets.
Yep.
Qualified plans, which is what the Solo K or the 401k rules fall under. They fall under a little different set of rules than the IRA accounts. So here's a really cool thing about it. IRAs offer asset protection, but you have to look on it at a state-by-state level. Sometimes there's dollar limits, depends on the state, right? And there's various factors that are involved. Here's the great thing about 401ks and these plans we're talking about. Those plans are judgment-proof in all 50 states. Okay, they're judgment-proof in all 50 states. So what does that mean? If you file a personal bankruptcy, the court will not attach a judgment to those 401k assets. If you have a business that goes bankrupt, the court will not attach a judgment to those 401k assets. If you are tried and convicted of a criminal offense, the court can take your life, but they can't take your 401k. Doesn't seem right, but that's how it works, right? And so when I say judgment proof, when I talk about asset protection, that's what I mean. So there are just layers upon layers of benefits to the 401k that make it far superior to just a regular IRA, truthfully.
Sure. So why would anybody do a self-directed IRA? What instance would you advise that over a 401k?
Well, there's a couple reasons why somebody would choose to do an IRA. And actually, let me give you 3 reasons. One reason is that they may not qualify for the 401k. So as a general rule, you can be a sole proprietor, but you have to have a business or the intent to have a business.
Okay.
to set up a plan, because 401ks, even though it's just for you, Mike, or you and your wife,
Yeah.
the reality is that it's sponsored by a company. It's a company-sponsored plan, so you have to have a company sponsor it. That's your company. Now, again, not a deal breaker. You could set up an LLC, get an EIN, and now all of a sudden you have a company sponsor it. Not a big deal. But some people, they just don't have a company.
Right.
The second reason why people don't do it is because and this is the biggest reason, they're not aware of it. Most people, IRAs are much less sophisticated to manage and offer and administer than 401k plans. So the reality is, a lot of people don't offer 401ks because they don't want to mess with it. So many companies don't offer 401ks. They certainly don't offer self-directed 401ks. And so it's just not an option that's available to most people. You have to find a specialty company that provides this. The third reason why some people elect not to go with a 401k is that, and I'm thinking of one well-known competitor, if you look at their self-directed 401k, the fees start at $2,000 a year versus an IRA that might start at $200 a year. Right? Big difference in price. We believe that this is such a powerful plan. We were very aggressive with the pricing and worked to create some efficiencies in it. So the reality is, at least with us, Mike, the fees are very similar to an IRA. So the fees aren't really a reason not to do a 401k anymore, but those first two reasons do stand out. Somebody has to qualify because they need to have a business or an intent to have a business, and then they have to be aware there's even an opportunity and find a company that's willing to offer them that opportunity.
Sure. Okay, fantastic. Well, let's switch gears here before we run out of time and talk a little bit about health savings accounts. So I know those are also a powerful vehicle, and they're not, I've heard some things recently or over the past year that really were eye-openers to me as to what you can use those things to pay for, which was counterintuitive to what I thought. So maybe you could kind of shed some light on an HSA health savings account and some maybe just talk about some misconceptions and kind of how they could be a powerful tool as well.
Yeah, so HSAs are one of my favorite accounts. And it's one that you won't hear anybody talk about. The reason why I love it, and by the way, I use it. Okay, so I have one myself. So everything I'm sharing with you, I do myself. So I use the Roth 401k, I use HSAs. So, and the reason why I use this is because the HSA is huge, particularly under the new age of the new healthcare, right? So costs went up, premiums went up, that is, and for most people, they've seen coverage stay the same or not as good. Okay, it's not a political discussion, it's just financial.
Right.
Here. So, but here's the great thing about it. When you have an HSA, what it takes to qualify for a health savings account is what's called an HDHP, high deductible health insurance plan. So the way this concept works is that you have a high deductible on your health insurance plan, and the idea is that you pay first dollar up to your deductible, right? So it's kind of like car insurance, right? You have a deductible on your car insurance, you pay up to the deductible, anything over that the insurance company pays. Same concept with health insurance. So what happens is you set up the HDHP. The first thing is if you're on standard health insurance right now, this will cut your premiums up to 40 to 50% a month in actual dollar savings. When I went from standard health insurance to my to a high deductible health insurance plan, I shaved about $300 a month. What did I do with that $300 a month? I contributed it to my HSA.
You're saying you shaved the cost because of the high deductible?
Right. When the deductible went up, right, my premium went down.
Right.
And so instead of giving the insurance company that $300 a month, I took it and I put it in my health savings accounts, right? Now here's the cool thing about it. Regardless of what my income level is this year, I get to take a full deduction on every single dollar I deposit in my HSA account. So that's benefit number one. Benefit number two is that if it's a self-directed HSA, right, I can go out and buy, as an example, a rental property in that HSA, and now all of a sudden, all the money that the tenant's paying in rent, right, comes back to my HSA. Guess how I'm going to pay for all my medical expenses and my deductible this year? Through that rental income coming back into my HSA. So you can invest in anything you want in that HSA, pretty much. Same rules apply as they do the IRAs when it comes to investing. Next benefit is that when I pay qualified medical expenses, which that's pretty liberal, okay, it's pretty liberal. but qualified medical expenses paid from an HSA account, the money comes out 100% tax-free. The HSA is the only account where the government basically married together the tax benefits of the traditional IRA and the Roth IRA and brought them together in the same place.
Okay.
So you get tax deductions on the money going in, you get tax-protected growth on all your investments, and you get to spend all the money on qualified medical expenses 100% tax-free. Huge. Okay. By the way, one of the big advantages to the HSA, different than a lot of people are familiar with what they call medical savings accounts or a flexible savings account.
Mm-hmm.
But what's the downside of a flexible savings account, right? Basically, the downside is you got to be Nostradamus to figure out how to make that thing work, because you have to guess to the penny on the first day of the year how much money you need in that flexible savings account. Because if you guess too little, you're using after-tax dollars to pay medical expenses, out-of-pocket expenses. If you guess too much, what happens to the money at the end of the year? It goes away, it disappears, right? You don't get it back.
Right.
Not true with the health savings account. This is your account. This is your money. If you don't spend it this year, it rolls over year after year after year and grows. So this is your money. It doesn't go away. You can accumulate it over your lifetime. Another just quick benefit, Mike, to put it in perspective, is that you don't have to use money from your HSA to pay out-of-pocket medical expenses. It's an option for you, but you don't have to. Why might you not want to spend money this year that you contributed to your HSA? Well, because you might want to save and invest and buy a rental property that spins off consistent income every single month to cover all your future medical expenses. You might want to save for larger medical things, like orthodontics, as an example, right? So I have 4 kids. Unfortunately for me, all of them need braces, right? And so I'm with my oldest one, actually, right now, who is, orthodontists make a lot of money, it costs a lot of money. I can use my HSA account to pay for all that pre-tax, right? So I can save for that expense in that account.
And just to clarify, those are kind of at the family level, is that right? I mean, you can use it to pay for.
Right.
Yeah.
So the HSA, the way the HSA works is that you set it up, and your contribution limits are based on, do you have an individual health insurance plan or do you have a family plan, right?
Okay.
Family is defined as more than one person, and individual is obviously just you yourself.
Okay.
And when you use money from the HSA money can be used for anybody covered under that plan. So I can use it for myself, my spouse, my 4 kids, right? Anybody covered under that plan. Okay. All those expenses, right, can be paid from that plan.
So with an HSA, help me understand how, everybody wants to believe that they are bulletproof and they're never going to get sick and things like that. Of course, if you do, you'll be glad that you socked away a ton of money in here. But it's a little, how do you not get too much money in there? And I guess later in life, what are some things you could use that on that aren't necessarily, true medical expenses? Is there a way to basically make sure that doesn't get trapped in there, I guess?
Yeah. So, I'll give you a couple of answers to that. First of all, it's a brilliant question, fabulous question.
I am brilliant, Edwin. I am brilliant. No, I'm joking.
Well, that's why you.
But I think that's people. I think automatically assume I want to get enough in there, but not too much, because they fear of nobody wants to believe they're going to have some major illness or something in their family that's going to cost hundreds of thousands or millions of dollars. Of course, it could happen, and knock on wood, hopefully it doesn't happen for anybody that's listening to this. But I'm curious what else you might be able to use these things for, or how you prevent that from happening, I guess.
Yeah, so I'll give you a couple examples, but let me say first, I've never seen anybody save too much money in an HSA. Yeah. Never happened. Okay. Not yet. Not that I've seen. Second thing that I'll say is that Ben Bernanke, right, the former Fed Reserve chairman, right, if we all remember Ben Bernanke, came out with a report years ago. And what he was talking about was the healthcare problem. This is one reason why healthcare has been on the minds of government officials for so many years, because what Ben Bernanke's report showed years and years and years ago was that the largest single expense in a family is healthcare. Now, I actually think it's taxes, but apparently they don't consider that an expense.
Right. So, that's an investment in your government. Yeah.
That's just our privilege, right? So, but people don't think of healthcare as their largest expense. Why? Because most people don't even know how much they pay for their health insurance, because it's auto-deducted out of their paycheck. If they're an employee or they get a W-2, the company picks up some portion of that. Then you have co-pays, you have deductibles, right? You have out-of-pocket expenses on medications, those kinds of things. Nobody takes the time to add all those numbers up. But the reality is what the Federal Reserve found out through this research is that healthcare is the single largest component of personal GDP in terms of what the income is and what the expenses are. So not only that, what they also found was that the average person, once they retire and they're on Medicare or Medicaid, right? So that the average retiree today, this is not future, this is today, needs to have approximately $220,000 for out-of-pocket medical expenses that they're expected to spend over their remaining lifetime.
Wow.
How many people do you know who have $220,000 set aside just for medical?
Right.
Nobody. Right? Nobody has. That's why I say I've never seen somebody save too much money.
Yeah.
So what I'd say is that first of all, the goal should be to get about $200,000 in that account to cover the out-of-pocket expenses, because most people that I know who are retired have to pick which medications they're buying every month because they can't afford all of them. But here's the other thing. So one of your questions was, well, what are the other options if you don't use all the money? Well, here's another really, really huge, cool benefit. This is for the Flip Nerd audience only.
All right.
So I don't show
exclusive.
This is exclusive here. So, are you familiar with long-term care insurance?
Yeah. In fact, that's what's been going on in the back of my mind. So, you read my mind.
Right. Critically important to have. You don't want to end up in a Medicaid nursing home, which nobody wants to end up there, right? If you don't know what one looks like, go visit one. You'll never want to end up there. Long-term care insurance is very expensive insurance to buy. However, one of the things that the government put in the rules is that as long as that policy meets certain requirements, which most will, you can actually use those pre-tax dollars, those non-tax dollars from the profits and income you generate in that HSA to pay your long-term care insurance premiums. So you can actually fund long-term care from pre-tax dollars from an HSA. I mean, if you factor in the tax benefit alone on that, you're talking about like taking a 30 to 40% discount on the actual cost of that insurance to you yourself. So that's another huge benefit to the HSA. And so that's one of the things that I would tell people to do. I would focus on having out-of-pocket expenses covered from that HSA in the future, and I would focus on being able to fund a long-term care insurance program from your HSA. Those would be
one of the great things about it too is it's at the family level. So if you're married and it's not like you have to anticipate which of us is going to be the sickest or need the most care. It's like, hey, we have kind of a blanket policy over our family. So yeah, that's fantastic. Well, Edwin, we've run a little long on time here. I would love to talk some more about this, and we may have to have you back again to talk about it. But if folks want to learn more about some of these just kind of awesome vehicles, and I know that after you use them a little bit, they're not that complicated, but you definitely want to work with somebody that that knows what they're talking about, knows the rules, knows how to navigate around what the rules are, or in line with what the rules are. Where should they go to learn more about this?
So the best place to go and learn more is our website, and that's www.specializediraservices, with an S on the end, specializediraservices.com. And when you go to our website, there's a lot of great information, articles, blogs, those types of things. But one of the things that we offer that's very valuable to people starting out or even very experienced is we have a free education and training package that we offer on that site. It comes with a training video, a training manual, as well as a free consultation. That free consultation, truthfully, Mike, is the most valuable thing that we offer. And the reason why is just everything we're talking about.
Yeah.
There's no cookie cutter approach to this. Everything is customized.
Right.
Like we were talking about the difference between a Roth IRA and a Roth Solo K or the HSA. Which accounts are best for you? How do you use them? What are the rules and regs that apply based on the kind of deals you're doing? So that's where that consultation comes in. So again, we offer that free of charge, and you just go to our website. You can sign up for that on the website there.
Okay, awesome. Well, Edwin, thanks so much for your time today. We're going to put the link to the website down below here, and appreciate you being with us. It's very fascinating information, and I think most of us in the real estate game are in this to build long-term wealth and security, and so sometimes we forget that. We kind of get caught up in the day-to-day and doing deals for more of a short-term approach, but ultimately I would argue that most of us got in this for the long term. So this is important stuff. So thanks for sharing it with us today.
Thank you, Mike. I appreciate it.
Yeah. Take care and please stay in touch, okay?
Yeah, absolutely.
All righty. Bye-bye. Are you a member of flipnerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit flipnerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry. So get on over to flipnerd.com.